Good evening and welcome to the Money Show, the show that puts your money matters front and center in a world full of financial noise. We are here to bring you clarity, confidence and control over your personal finances, whether you are planning for retirement, building a portfolio, navigating debt or just trying to make smarter money decisions. This is your space, your guide and your weekly check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trend and answer your burning questions on saving, investing, spending and everything in between. Because you're on the Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice. So let's dive in. I'm Kavita Thapliyal, your host, and let's begin with our very special initiative, Bharat Nivesh. The beginning of the month often marks key financial activities, salary credits, bill payments, and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments as well. Now, to encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Behtar Nivesh, Behtar Kal. Now, the objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. Now, as part of this campaign, we observe 4th of every month as a monthly reminder to ensure that you start your mutual fund SIPs or ensure your existing SIP continues. So go on, set your reminder to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. And today on this very special segment, we have with us Vishwajeet Parashar, mutual fund expert, who will talk about everything investments, and the topic in focus is when to book profits in mutual fund. Vishwajeet, hi, good evening, welcome to the show. And a very important topic that we are talking about today. And you know what happens usually is people invest in mutual funds, and when we talk about investor struggles related to their investments, they usually know when to invest but not when to exit. So what's the golden rule over here?
Yeah, thank you, Kavita, for having me in. And the topic is very interesting because it's a classic, dilemma: when to exit your mutual funds. So I think the first and foremost, you should exit your mutual funds or you book the profits when your financial goal is quite near. So don't wait for the exact date to exit the mutual fund. But if you are near, let's say 6 months or 1 year before the goal, you can definitely plan to exit, because equity markets can surprise you at the last minute. So don't wait for the last minute. Maybe 6 months, 1 year is a good period before the goal. You should start exiting and start booking the profits from the mutual funds. And second, most important thing is when you want to book the profits, because it's very, it's the greed starts setting in when the markets are going up. So the best strategy which could be for booking the profit is, I would say, is strategic asset allocation. Now, what is strategic asset allocation? Before anyone starts investing, one should check his or her risk profile, whether you are a conservative investor, whether you're aggressive or a moderate. And accordingly, you should set your asset allocation. When I say asset allocation, suppose you have 100 rupees to invest, you should diversify in different asset classes, and that number should be very clear to you. Let's say you are a 50 years old person, and let's say you have to invest 10 lakh rupees. So your asset allocation could be 50% in equities, 40% in debt, and 10% in gold. So now, if you know this asset allocation, I can guarantee you the 91% success of your portfolio depends on this, because then greed or fear will never ride you, and you can take the balanced approach when it comes to your profit booking. So what happens? Let's say last couple of years we have seen 4 years equity markets was on a bull run, and then last 1 year you could see gold was doing exceptionally well. So what normally happens when the gold is doing well, people feel that, oh, again it will go up. So you keep waiting for the profit bookings. Now, ideal scenario would be, let's say your 10 rupees gold has become 15 rupees. So you should withdraw 5 rupees from gold and bring it to an underperforming asset class. It could be debt or equity. So now if you do like this, or for example, if the equity market, let's say your 50 rupees has become 65 rupees or 70 rupees. So withdraw this 20 rupees and bring it back to debt or gold, whichever is underperforming asset class. Now, if you do this, you will always be free from, this fear or greed when the market will go up, because nobody ever able to time the market. So don't even try to do this, that you will be very successful or you will be very intelligent enough that when the market go up you will withdraw. Nobody can ever do it, and the greed sets in. So best is follow this asset allocation approach, and I think 90% of the problem is sorted.
Right.
Third is when
Right.
you want to exit, always make sure that your taxations are in place. So if you have just invested, let's say 1 year back, or 1 year is
Right.
not complete, you could be in a short-term capital gain tax.
Right.
And so
Right.
wait for long term so that you don't have to pay extra tax.
All right. See, I mean, these are very important thumb rules that one really needs to keep in mind when they are planning an exit from a mutual fund. But I also want to understand the profit booking ratio. A lot of time investors, wait till they achieve 10% or 12% profit. So should profit booking be based on returns achieved, say 12%, 15% with time horizon or market levels? What's a more rational way to think about it?
Yeah, Kavita. So when let's say if you have set a target, so whatever happens, let's say I've achieved 10%, so then that is a good time to exit. But the best strategy is don't exit in one shot, don't exit the lump sum. So make it you should always exit in a very segregated way. Don't part straight in one shot. You can exit in partial manner. So wait for 20%, let's say 20% you can withdraw the profit booking, and wait, let the rest of the investment remain invested. So best is don't exit in one shot and do partially. That is in a staggering way. That's the best approach when you want to exit the mutual funds profits.
All right. What happens is many investors get nervous after a rally and pull out too early. What are the common mistakes people make here when they are booking profits, when they're pulling out early, when they're nervous about a market rally? Because as we all know, it is inherent behavior of the market to be volatile, right? But then just looking at a rally, should you be booking profits, and how can you deal with it? It's what kind of a mistake is booking profits at that time?
So absolutely, Kavita, this is what I was telling about strategic asset allocation.
Right.
So first of all, you should never exit your investments depending on the market fluctuations in a short term or a long term. So you should be continuing with your investment strategy, whatever you have set in. So if your asset allocation, let's say your equity has jumped from 50 to 70% or 65%, then you can book the profit and you can come to an underperforming asset class, be it debt or gold. But don't exit just because there are market fluctuations, just because there is a panic in the market. So you should always assess your asset allocation, let's say once in a year, or if you see the markets have done exceptionally well or they have gone down exceptionally down, then at that point of time you can consider your portfolio rebalancing. But you should not exit just because 2 3 days market is very fluctuating or volatile. You should, I think, continue to remain invested, because mutual funds, you make more money, you buy more units when the markets are down. So it is always a long term approach that you should follow when it comes to your investments.
All right. Now, I also want to understand one thing, does profit booking mean completely exiting a particular fund, or should one follow a partial redemption or rebalancing strategy? How can that be strategized?
Absolutely, Kavita. So I think my advice would be never ever exit the mutual fund completely, because then you cannot never you are never time the market. So what will happen is, suppose you have exited completely and the market goes up, you will feel bad that you have exited completely. So it is always a good approach. Let's say the markets have gone up, book a partial withdrawal, or maybe a staggering approach could be a best strategy. Let's say next 3 to 6 months or 1 year, you can withdraw the mutual funds. Don't exit in one shot. I think that would be the best strategy to follow.
All right. Also, one thing, I want you to help our viewers also understand this. How often should this thing be done? Booking profits quarterly, yearly, or only during major market moves? We understand that you need to be in a fund for a specific financial goal, and there needs to be consistency. There needs to be discipline. But then a lot of time rebalancing, as you also mentioned a lot of time, that asset allocation, diversification really plays a very important role. And we also touched upon rebalancing or reviewing your portfolio. So how should one go around it? Quarterly, yearly, every 3 months? How should we adopting this rebalancing and booking profit strategy?
So, Kavita, there is a slight difference between reviewing your portfolio and rebalancing. When I say rebalancing, that means it is within the asset classes. So let's say equity has gone up 10, 15, 20%, then that's a good time to rebalance your portfolio. Or otherwise, standard approach would be at least once in a year, you should rebalance your portfolio. But when it comes to review your investments, then you can always see that some mutual funds are not performing or they're underperforming from quite some time. And then that is a good time to exit when you feel that almost one cycle has gone and this fund is not performing when we compare it with peers or the benchmark. So that would be a good time to approach exit the mutual funds, that particular mutual fund. But that is a review of portfolio. Rebalancing should be done once in a year, and when the markets have really gone up or really gone down, that is the best time to rebalance your portfolio.
All right, one last question and then we'll wrap up this particular segment. Should profit booking decision differ from SIP investors versus lump sum investors?
Yeah, that's a very interesting question because when you book the profit SIP, you have to give a 1 year because there are exit loads. When you invest, so better is when there is a lump sum investment. I always suggest that you should stagger your redemptions or exiting the strategy. But when it comes to SIP, you should at least wait for 1 year so that there is no exit load. And best practice is that when you are doing an SIP investor, wait for at least a couple of years so that the magic of compounding starts working in. And if you are achieving your goal, you are near your goal, only that point of time you should exit the mutual fund.
Dr. Suman's question, and Dr. Suman has HDFC Nifty 50 in the portfolio, 5,000 rupees SIP going on, Parag Parikh Flexi Cap, Motilal Oswal Mid Cap, Nippon India Small Cap, ICICI Pru Large and Mid Cap, SBI Contra. The questions are HDFC Nifty 50, can that be switched to HDFC Flexi Cap? And should he also start a new SIP in Kotak Multi Cap? Is that needed? He wants to step it up by 5,000 more and wants to add a new fund. And any other changes that's needed in the existing portfolio. The overall portfolio value so far is 10 lakh rupees and the target is 3 CR in 15 years. And other investments he has in NPS, where the value is almost 35 lakhs, and PPF value is 5 lakh. And he also has a PLI scheme. The value over there is 6 lakhs.
So I think Dr. Suman has created a very well diversified portfolio. He has invested across different market caps, whether it is a large cap, mid cap, or small cap. So congratulations, Dr. Suman, a very well drafted portfolio. I would say you don't need to exit HDFC Nifty 50 fund because it's a pure large cap fund. And considering the present market scenario, we are all saying that large caps are more favorable because of valuations perspective. So ideally, you should stick to the fund which you are invested in, and also you already have one flexi cap fund. So that is a Parag Parikh Flexi Cap Fund. And if you switch from HDFC Nifty 50 to HDFC Flexi Cap Fund, I see there is a huge amount of overlap. So that is also another point why you should not exit HDFC Nifty 50 fund. So remain invested. And also you have asked this question whether you want to park another 5,000 rupees in a Kotak multi-cap fund. So I think your portfolio is very well diversified. You have large cap, mid cap, small caps. You don't need ideally a multi-cap fund because it is anyways diversified across market cap. This 5,000 rupees ideally you should increase in the existing funds rather than adding another fund and creating a bigger portfolio to manage or track. So my advice would be to increase this 5,000 rupees to the existing investments, existing funds, and then don't increase another fund to your portfolio. When it comes to your goal, you have set a goal of 3 crore rupees, and this amount of 36,000 rupees. Let's say if you invested this SIP for I think 15 years, that's a good time period, good time horizon, and assuming 12% CAGR, you will be able to achieve 1.71 crores. And also your existing 10 lakhs would become 54.73 lakhs. So you are approximately 2.25 crores and little short of 75 lakhs from your goal. So ideally, if you can increase your SIP every year, step up of 6% to your annual SIP, I think you will be able to achieve your 3 crore goals only from mutual funds. But otherwise, NPS is also, you're doing a good investments. You're doing 37,000 rupees per month, and there is already a corpus of 35 lakhs. So this both together will also become 3 crores after 15 years. So I think you will be able to achieve a 6 crore goal from both these investments. So I think you're all set. Increase your SIP by 6% step up every year, and rest, I think the portfolio is very well diversified.
All right, fantastic. Let's move on. Let's take Gaurav Sharma's question. He's from Nasik, working in private sector, and he's 36 years old. Current portfolio has 20 lakhs accumulated, doing SIP of 31,000. Require corpus of 4 crores at the age of 50. He's got Mirasit large and mid cap, Motilal Oswal large and mid cap, Motilal Oswal mid cap, again Nippon India large cap fund, Bandhan small cap, Kotak multi cap, Invesco India flexi cap. So he wanted to review his portfolio in terms of fund mix, and he's also comfortable doing a step up of 10% every year.
So I think Gaurav also again, Kavita has a good, well diversified portfolio across market caps. So he has, some of the best performing funds, whether it is a Nippon small cap, Nippon large cap, sorry, Bandhan small cap, Kotak multi cap, Motilal Oswal mid cap. So he, in his portfolio, what I could see is there are two large and mid cap funds, and there is an overlap in these two funds. And also, he has two funds from the same AMC of a similar category. Kind of a similar category because Motilal Oswal large and mid cap and Motilal Oswal mid cap. So I'm assuming there would be a good overlap because both are investing in mid caps. So my suggestion would be if we can switch from Motilal Oswal large and mid cap to a different investment style, let's say value investment style. So that would be a good, diversification in his portfolio. So he can switch from Motilal Oswal large and mid cap to ICICI value fund or DSP value fund, a different investment style that will add to the diversification to the portfolio. Rest, if you could say, if I come to his goal, I think his current portfolio is 20 lakhs. So 12% CAGR would make it to around 98 lakhs in 14 years. Whereas his 31,000 SIP, assuming 12% CAGR, would become 1.28 crores. So this together becomes almost 2.25 crores. So now to achieve the goal, he needs 1.75 crores, which is a huge sum. So what ideally he need to do is he need to add 15% annual step up to his SIP, and that's it. And he will be able to achieve this goal of 4 crores. So just a small change from Motilal Oswal large and mid cap to ICICI value style fund and 15% step up, and I think he's all set to achieve his goal.
All right, that's good for him. But then let's move on. Let's take Rohit's question. He's 24 years old, working as a professional, and he would like to invest 10,000 per month in small and mid-cap categories only. He's an aggressive investor and can easily handle the bearish phase of the market. His time horizon is 20 years, and he wants a fund choice from you.
Absolutely. So, Rohit, very nice to hear that you are an aggressive investor and you understand the ups and downs of the markets, which is very good. So, when you are asking about mid and small cap, and I would like to suggest that when you're investing in equity, that itself is it's an aggressive asset class. So, you need not be purely into mid cap or small cap just to just because you feel that you are an aggressive investor. So, ideally, a balanced portfolio means you will risk and reward ratio is all set will be well set, and even large caps also deliver good returns at times. So a couple of years you will see a decent return rally in only in large caps and not in mid cap and small caps, and that is why we suggest a diversified portfolio. But since you have asked a mid cap and small cap, I would suggest you can go for either a Kotak mid cap or HDFC mid cap fund in the mid cap category, and in the small cap category you can consider Nippon small cap or Bandhan small cap. So you can choose between these two funds, and if you are doing a 10,000 rupees SIP, just to give you some perspective on the numbers, in 20 years, which is a good time horizon, Rohit. So I think you will be able to achieve 91 or 92 lakh rupees kind of a fund with a 12% CAGR. But if you step up 10%, then again it will be almost double. It will become almost 2 crores. So ideally, keep stepping up every year so that you achieve a good corpus and let the power of compounding work magic for you to create a big corpus for you. All the best.
All right. On that note, thank you so much, Vishwajeet, for being on the show and helping our viewers understand every aspect of their financial planning and how to go ahead with that. Thank you so much.